The Jumpstart Coalition for Personal Finance Literacy is a Washington, D.C. based group that promotes the education of personal finance to young individuals to increase their financial literacy. The Jumpstart Coalition published a list of 12 must-know personal financial rules for people of all ages a few years ago. Do you want to learn more about these ideas and personal finance in general? If that's the case, please keep an eye out. This is FIRE, and we're here to help you with your money. So please subscribe and enable notifications to be notified of each new upload. Let's get this discussion started. Personal finance is a term that encompasses all aspects of money management, including saving and investing. Budgeting, banking, insurance, mortgages, investment, retirement planning, and tax and estate planning are all included under one umbrella. The phrase is frequently used to describe the entire industry that provides financial services to people and households, as well as provides financial and investment advice. Personal finance is concerned with achieving personal financial objectives, such as having enough money to fulfill immediate financial demands, planning for retirement, or investing in your child's college education. It all depends on your income, spending, living needs, and personal objectives and desires, as well as devising a strategy to meet those needs while staying within your financial restrictions. It's crucial to become financially literate to distinguish between good and bad advice and make informed decisions with your money and savings. The sooner you begin financial planning, the better. But it's never too late to set financial goals that will provide financial security and independence for you and your family. Here are some personal finance best practices and advice. The first tip is to learn how to devise a budget. Living within your means and saving enough to fulfill your long-term goals requires a budget. The 50-30-20 budgeting strategy is a fantastic starting point. If you want to learn more about this strategy, go to our YouTube channel and look for the most recent video we have on it. Thanks to a growing range of personal budgeting apps for smartphones that put day-to-day finances in the palm of your hand, managing money has never been easier. If you'd like us to make a special video on it, leave a comment below. It's also a good idea to set up an emergency fund. It's critical to pay yourself first to guarantee that money is set aside for unforeseen expenses like medical bills, major auto repairs, day-to-day expenses if you lose your job, and so on. The optimal safety net is 3 to 6 months worth of living expenses. Most financial experts advocate putting aside 20% of each paycheck each month. Don't stop saving once you built up your emergency fund. Continue allocating 20% of your monthly income to other financial goals, such as a retirement fund or a down payment on a home. You should keep your debt to a minimum. It seems simple enough. Don't spend more than you can make to avoid getting into debt. Of course, most people must borrow from time to time, and going into debt can be beneficial in some cases. For example, if it leads to the acquisition of an asset. Taking out a mortgage to purchase a home is one example. Regardless of whether you're renting a property, leasing a car, or acquiring a computer software subscription, leasing can often be more cost-effective than buying altogether. Just a gentle reminder to be cautious when using credit cards. Credit cards can be significant debt traps, yet in today's environment, it's impossible not to have one. They can also be used for purposes other than purchasing goods. They're not only important for building your credit score, but they're also a wonderful way to keep track of your spending, which can help you stick to a budget. Credit simply needs to be managed correctly, which includes paying off your entire balance each month, or at the very least, keeping your credit utilization ratio low. If you can pay your bills in full, it makes sense to charge as many purchases as possible. The most essential thing to remember is to avoid always maxing out your credit cards and to always leave your payments on time. Remember to take a break. Budgeting and planning can appear full of sacrifices, but make sure to treat yourself occasionally. You need to appreciate the results of your labor, whether it's a vacation, a purchase, or a once-in-a-while night out on the town. This gives you a taste of the financial independence for which you've been striving. Last but not least, remember to delegate when appropriate. Even if you think you're capable of doing your taxes or managing a stock portfolio, that doesn't mean you should. Setting up a brokerage account and spending a few $100s on a certified public accountant or a financial planner at least once might be a good approach to get your planning off to a good start. Before we go ahead and finally talk about the 12 principles of personal finance, please make sure to hit that thumbs up button and feel free to leave a comment or suggestion down below. You can start thinking about philosophy once you've established some basic procedures. Learning a new set of skills isn't the answer to putting money back on track. Rather, it's about realizing that the same ideas that help you succeed in business and your job also apply to your personal finances. Here are the 12 personal finance principles you should know. The first step is to determine your take-home or net pay. Before committing to big expenditures, estimate how much money is likely to be available to you after all obligatory deductions. The following step is to pay yourself first. Set aside a manageable amount each month in accounts earmarked for long-term goals and unexpected emergencies before paying bills and other financial responsibilities. You should definitely begin saving while you are young. Recognize that the interest you earn on your savings, as well as over the period which you save, influences your overall savings. Begin comparing interest rates today. To get the best value for your money, get rate information from several financial service providers. Always keep in mind, don't borrow what you can't pay back. Be a responsible borrower who pays back what you owe, demonstrating that you are creditworthy in the future. Compare your overall payment commitments with the income you will have available to make these payments before you borrow. Learn how to manage your finances. Make an annual budget to figure out how much money you'll have and how much you'll spend. Savings are included. This will serve as a guide to help you stay on budget. Money doubles when you apply the Rule of 72. So read more about it or leave a comment below if you'd like a special video on it. Anyway, divide the interest rate by 72 to find out how long it will take for your money to double. For example, a 6% interest account will double in 12 years. 72 divided by 6 equals 12. Keep in mind that high returns imply high risks. Recognize that on a guaranteed thing, no one will pay you an exorbitant interest rate. In most circumstances, the higher the interest rate provided, the greater the chances of losing some or all of your money. The greatest way to protect yourself against investment risk is to diversify your portfolio. Don't expect anything for nothing, my friend. Be wary of commercials, salespeople, or other financial offers that claim to deliver something for free or guarantee investment returns. As with non-financial prospects, if it seems too good to be true, it probably is. You should make a financial plan. Make a list of your financial goals, including their date and monetary cost, and devise a realistic plan to achieve them. Remember that your credit history determines your credit future. Credit bureaus keep track of borrowers' loan repayment histories, which are recorded in credit reports. Negative information on your credit record may limit your ability to borrow in the future. Lastly, make sure you're insured. To avoid being wiped out by a financial loss, such as an illness or an accident, buy insurance. Every personal financial plan should include an insurance plan. Keep in mind that these principles should be used as a guideline when making an investment or financial decision. Financial managers make judgments about operations, investing, and financing. Some of this was short-term, while others were long-term. We can improve our cash flow by using personal finance. By keeping track of our expenditures and spending patterns, we can boost our cash flow. We don't waste our hard-earned money on unnecessary things because of tax planning, sensible spending, and careful budgeting. What should we discuss next? Leave a comment down below. And that concludes today's video. If you want more videos like this, make sure to subscribe to the channel and turn on the notifications to be notified of every upload. This is Fire, and we'll see you in our next video.